Welcome to Capital Market Live from Channels Television, where you get an in-depth analysis of how your stocks performed for the week. I am Will Ibang. Let's get a quick summary of the market close for major indexes on the global scene now. For European stocks, they closed higher on Friday as the Stoxx 600 index crept up on the final trading day of the week. The Pan-European Stoxx 600 index closed up provisionally 0.4%. And on Friday, while sectors were mixed bag, chemical stocks rose about 0.9%, while tech shares slipped 0.1%. Meanwhile, in Asia, markets traded mixed, with Japanese data boosting the Nikkei 225 index, while Hong Kong's Hang Seng index plunged 1.77%. And in the U.S., the Dow Jones Industrial Average rose on Friday as the major averages notched a 4-week winning streak. The 30-stock Dow rose 0.3%. Meanwhile, the S&P 500 ticked higher by 0.06%. The NASDAQ Composite fell 0.1%, closing at 14,250 points. Major retail shares rose slightly as Black Friday kicked off the holiday shopping season. Walmart and Target rose 0.9% and 0.74% respectively, while Amazon ticked higher by 0.02%. Now, it's the fourth consecutive positive week for the major averages, the longest for the S&P 500 and NASDAQ since June. Meanwhile, the Dow hasn't posted a weekly run this long since April. Now, back home, the local bourse faced subdued momentum as investors traded cautiously. The all-share index rose by 0.17% week-on-week to 71,230 points, driven by buying interest in GTCO, which was up about 5.4%, and Zenith Bank, which was up 3.9%. Now, this weighed the profit-taking activities in Stanbic IBTC. As a result, the month-to-date and year-to-date returns settled at 2.9% and 39% respectively. Now, in terms of trading activity, the total volume traded rose by 20% week-on-week, while the total value traded declined by 18%. From a sectoral point of view, we see insurance, banking, and industrial indexes advancing while the consumer goods index declined. The oil and gas and industrial goods closed unchanged. Now, Mercure Industries topped the gainers chart for the week, while Thomas Wyatt led the decline in stocks. The three of Universal Insurance, Veritas Capital Assurance, and Unity Bank topped trades by volume. Let's look at the NASD market. We see that similarly, unlisted securities market closed in a green territory. The index rose more than 1% to close at 857.29 points. Turnover for the week was also positive. Volume climbed over 100%, while value traded rose by about 0.5% to 142 million naira. Haradel Holdings recorded the most significant gain as it rose by 10% to close at 871 naira 20 kobo. UBN Property followed as well as Friesland, Campina, Wamco. CSCS, as the Central Securities Clearing System, led the underperforming stocks. Now, also in that category, industrial and general insurance with a 7.41% downtick. And of course, we saw IGI, that's industrial and general insurance, stopping trades by volume as a result of the sell-offs. Now, the central bank governor, Mr. Olayemi Cardoso, has presented an economic roadmap and policy direction which is aimed at steering the country on the path to recovery. Now, the CBN governor will address bankers and stakeholders at the 58th annual dinner of the Chartered Institute of Bankers, CIBN, gave some insight on the economic and financial markets development during the year, as well as the economic expectations for the coming year. Meanwhile, the CBN governor says the financial market regulator is committed to monetary and price stability to boost macroeconomic performance by tackling institutional deficiency, upscaling core governance, and prudent policy direction.
The Central Bank of Nigeria is committed to achieving monetary and price stability. This is not just a technical objective, but it has real-life implications for the well-being of all our citizens. Through targeted policies, transparent market operations, and coordination between monetary and fiscal authorities, we can ensure a more stable exchange rate, control inflation, and create an enabling environment for businesses and individuals to thrive. That is what I, together with my team at the Central Bank, have been focused on doing in the past 2 months. We have critically reviewed the effectiveness of the Central Bank's monetary policy tools and have spent time fixing the transmission mechanism to ensure the decisions of MPC meetings actually result in desired objectives. For quite some time, there has been a dislocation of our monetary transmission mechanisms, rendering the MPC meetings largely ineffective. For the avoidance of doubt, the Central Bank of Nigeria Act 2007 requires that the meeting of the Monetary Policy Committee of the bank holds at least 4 times a year, and the bank has satisfied this requirement for 2023.
Now, joining us to discuss this from our Abuja studio is Mr. Pabina Yinkere, the business head, asset management, Norimberger. Good to have you on the program, Mr. Pabina.
Thanks for having me, Will.
Now, Mr. Cardoso, just as we've heard, the Central Bank Governor of Nigeria, Mr. Yemi Cardoso, made this maiden presentation since becoming governor in September at the CIBN annual dinner yesterday. What were your first thoughts? I mean, was it what you were expecting? What were the key highlights from his speech yesterday for you?
So this is this CBN governor's first official interaction with the market. If you recall, we haven't had an MPC meeting since he became CBN governor. The September meeting was moved. The November meeting was moved again. I think what the speech really centered on is trying to bring back confidence into the system, confidence in the CBN. In the last 8 years, what we have seen is largely unorthodox CBN policy. CBN trying to become, under the guise of trying to be developmental, is going into more fiscal terrain than monetary with its intervention programs and things like that. So it's pretty much seemed like the CBN had lost its focus. And I think one of the things Mr. Cardoso is trying to bring back is to come and tell the market that the CBN is back to its primary mandate of price stability. One of the key takeaways for me in this session is that he guided to the fact that monetary policy meetings may likely not hold again this year, since he said they've satisfied the 4 requirements based on the CBN Act. So we will likely see the next monetary policy meeting in January. And I also think this is strategic because it gives the new CBN governor time to reassess the plans that they have had all this while, time to reassess what the economy is doing and come up with policies that can really be fit for the time that we're in. I understand where he's coming from. It's a difficult situation to want to come in at this time. Remember, we've had consecutive rate hikes under the previous CBN governor, and it is getting to a point where businesses are squeezing from high interest rates. The economy is tough. So you don't want to come in and continue to increase interest rate, but at the same time, you don't want to signal to the market that you are relaxing on your objective of trying to fight inflation with higher interest rates. So I think it's a good way to escape from what a difficult situation is. Be that as it may, another highlight that I take away from this session again is that he's reinforcing the fact that there would need to be further tightening going into next year, but of course giving himself time to do that as well, because inflation remains a problem. Yes, from the latest MBS data, we can see that inflation is on the scale at which is increasing, is slowing down. Nonetheless, on a year-on-year level, still very high inflation rate. So it gives some time to see the pass-through of previous policies on inflation and then decide how next you want to tackle that. So I think that's another key highlight coming out of that session for me again. And finally, one of the things you also noted is that banks may need to recapitalize. And I think this is key as we go into a period where Nigeria is coming from a very tough economic landscape. I think the comments, I think, were pretty on point, if you ask me.
Okay, so I'm just going to bounce off what you just said, talking about the recapitalization of banks. But what could be the potential effects of such move? What does it say to the investing public out there that are interested in Nigeria, knowing that the banks are like the big guys in the country, and knowing that they have, does it send any message out there to the potential investors?
I think the message it's trying to send to investors is the Nigerian system is solid. We just need to prepare for further growth. I think that's the message it's trying to say. Remember, the government has a 10-year target to raise Nigeria's GDP to $1 trillion. If you want to do that, you need big banks. You need banks operating at a very large scale. So that's the driving force behind that comment of bank recapitalization. But I think most of our top-tier banks should not worry about this. They are very well capitalized. It's more the tier 2 and tier 3 banks that may likely need to go and raise new capital. But the assessment from looking at the banking sector and how they've come through this difficult period, our banks remain strong, our banks remain solid. Capitalization is still decent, but I think the comment is more or less in trying to ensure that we create a platform for future growth, for strong growth that we envisage in the economy.
Okay, there's something else that the CBN governor talked about in terms of, talking about inflation, and he's talking about tightening for the next 2 quarters. We know that there are potential challenges or risk for extending, implementing tightening measures for an extended period, especially for the markets, the equities market. But looking at what is the significance, he talked about switching to inflation targeting. What are the significance of adopting an explicit inflation targeting method instead of the monetary policy, monitoring method that they've been using since forever?
Yes, so his main objective, like I said, is price stability. And to establish price stability, you can do it in many ways. But if you look at Nigeria, inflation has been a big headache for us over the last couple of years. And I think coming back to inflation targeting suggests to me that he's trying to signal to the market that our objective is to focus. Our objective is to come up with metrics that we can track. If you recall, under the previous governors, I think the early days of Emefiele, we had an inflation targeting where we had a 6 to 9% inflation target. But of course, what has happened subsequently during Emefiele's tenure was that inflation had shot up way above that. If Cardoso is going to come back to the inflation targeting, they need to reassess the economy as a whole and decide what level of inflation is suitable for the kind of growth that we want Nigeria to go through. Recall, if you want to go to a $1 trillion economy in 10 years, what it likely means is that the economy will have to be growing at well over 10% each year for the next couple of years to achieve that target. That is quite an ambitious target. And if you're going to be driving that kind of growth in the economy, you need to make sure that you have a good handle over inflation, because inflation can be a destroyer of value.
So what are some of the potential challenges or criticisms that might arise in response to the governor's proposed policy changes? Do you see any challenge ahead of him?
I think he's speaking the right languages. He's saying the right things. If you recall, like I said earlier, the last CBN governor had come up with so many unorthodox things. And I think one of the things this CBN governor wants to do is to bring back that mandate of the central bank, remain focused on monetary policy, don't delve into the fiscal aspect of it. A lot of the developmental objective of the CBN may likely need to be channeled through banks. And I think in doing this, what he has done is to instill confidence in the market, to see that we have a CBN, a new CBN that is focused, a new CBN that is dedicated towards what it wants to do with regards to monetary policy and price stability. So I think he's saying the right things at this time. Potential challenges for me would be still trying to tame this high inflation. It's very stubborn, and it's born out of some of the necessary evils that we had to take as a country. So that will be one. It's not going to be easy fighting inflation. I will tell you that for free. Another thing he must also look at again that may potentially be a challenge is the FX situation. And if you recall, the Naira has been under severe pressure for much of this year. And part of what is driving that is because of our reserve level and the lack of FX inflow that comes in. So he needs to create the enabling environment to attract foreign inflows. He needs to create the enabling environment to ensure that our reserves continue to grow. Those things are no easy feat. I mean, we say it as it is, but in practicalizing them, they're not going to be easy. So I think he's going to face challenges on those two fronts the most, trying to drive inflation down and, of course, trying to ensure currency stability. Those will be the challenging points for him.
I do hope the central bank governor will do us wear a very thick jacket because he has a whole lot in front of him. So capital markets will continue right after the break. Do stay with us. This is Capital Market, live from Channels Television. Thanks for staying with us. Now, on Friday, the National Bureau of Statistics released the second and third quarter GDP report. According to the latest data, Nigeria's GDP rate grew by 2.54% with the last 3 months to September, and that's slightly higher than the 2.51% growth recorded in the second quarter of this year. Mr. Pabina Yinkere, Business Head Asset Management Limited, Norumbeja, is still with us in our Abuja studio. Mr. Yinkere, the numbers seem to be climbing just bit by bit. Doesn't look so great vis-a-vis skyrocketing inflation, FX volatility. We know all our headwinds. What can companies, investment houses, advisory houses, investors do to hedge against these situations?
Yes, so the growth figures still very, very fragile and understandable. If you look through what we have had to do when the new president came on May 29th, we quickly removed subsidy. We quickly tried to float. I mean, there are so many things to that now, but we quickly tried to create a more enabling foreign exchange environment. So these key measures, yes, measures the markets had been calling for, but it's left a very difficult, very difficult situation for the Nigerian consumer, for the average Nigerian out there. So on the back of that, we've seen these growth numbers coming in not so strong. The growth is, again, being driven by the services sector. We see agriculture, turning out very weak, one of the weakest output numbers you've seen from agriculture in a long, long time. The industry sector remains challenged, even though we are seeing some recovery in the oil and gas side. So the services sector, again, was left to drive growth. When it comes to investing, what we likely see, or what we are seeing across our clients, is that many people are trying to provide some hedge in their investments. So you see people going into a lot of dollar-denominated type investments. And one of the things that I think is appealing at this time, if you look at our fixed income market, interest rates are about the highest they've been in a long time. The longest end of the bond curve is trading in and around 17–18%. So it's a good time to lock in these figures. Yes, you would say 18% is great, but inflation is running towards 28, maybe possibly 30 before the end of the year. But what investors should know is that inflation is transient. By the time we get into next year, and particularly from the second half of next year, we'll begin to see inflation come down. So if you can lock in into high interest rates like we're seeing at this time, over the long term, it can provide some value for investors. And interestingly enough, Norumbeja has just launched a new fund, fixed income fund, which aims to take advantage of this high interest rate environment. So those are the places we are guiding investors to. Yes, we've had very stellar performance on equities, but going forward, I don't think equities are going to be the toast of investors, because if you recall, there is an inverse relationship between equities and bonds. When bond yields are high, equities don't do so well, and vice versa. So now we're going into a high interest rate environment. We're in a high interest rate environment. I would expect the rally that has accompanied the equity market to cool off, as we go into the end of the year and into next year as well.
Hold on, Mr. Inkere. Slow down there on the equities market being going to be the toast at the moment because of the high yields in the fixed income space. We did know that the last auction, we saw that 16.5% uptick for the long end of the paper, so the 365 paper. That's for the primary market auction. And we know that similarly is going to trickle down to the secondary market. But we do know that the equities market we know it's quite risky and the fixed income is safe haven. But what are the things that you say for fixed income? Do you think the fixed income yields in the fixed income space can definitely match? And you're saying for certain that to match the inflation rate that we are heading for, which is about 30% that we are going to be seeing by December, hopefully not.
Yes, my forecast is that inflation would hit about 30% in December. But then, as we go into next year, we'll begin to see base effect come into play. What that means is that going forward, inflation won't be as high as it has been. A good reading, yes, the figure is still high, but if you look at the month-on-month increase in inflation for the month of October, it was lower than we had in the month of September. So which means that inflation is actually, for the month of November is lower than what we had in October, which means that inflation is gradually coming down. I think that is one positive signal we must take out of it. Yes, the headline number still looks precarious, but then if you monitor this month-on-month trend, you would see that we may likely come into a situation whereby inflation begins to taper down. Now, if you lock in, remember, if you're buying a bond now, if you buy, say, a 10-year bond, you are locking in that yield for 10 years. Is inflation going to be 30% for 10 years? I don't think so. Have we gone through the worst phase of our inflation? I would say yes. So like I forecast, we should see inflation hit just about 20% by half year next year. And by the end of the year, I think we'll be sub 20%. You are beginning to get to a situation whereby the yield on long-term bonds are beginning to match with inflation. So that's how to look at it. Let's not just look at inflation in one place. Investment is a long-term gain. You want to look at it over the long term and don't be swayed by, blips or increases, temporary increases in things like inflation. I don't think that is the mindset an investor should hold.
Okay, so we've seen that despite the concerns, the inconsistencies in monetary policy from the MPC meetings were postponed, we see that the market still closed in the green. That's the equities market. Overcoming pressure from profit-taking activities during the week. What would you say drove that? So you say that the market is still not bullish enough to match inflation and probably match the returns on the fixed income space.
No, the equity market is doing better than inflation this year, doing better than fixed income. I think primarily that's been driven by the optimism that came with the new government, the optimism with the removal of subsidy, like I mentioned before, and the move towards adopting a single exchange rate window. The optimism from the combination of those things drove equities. Also, another factor which people don't really pay attention to is the fact that because we have devalued our currency, what it means is that Nigeria assets, from someone looking outside in, Nigeria assets are much cheaper than they used to be, So if the market is offering that kind of value, of course, you would think that investors would jump at it. But going forward is where I'm speaking to now. I don't think equities would present as compelling an investment option like fixed income would if one is able to lock into these rates. The equity market is down to 39% year to date. Fantastic, better than inflation. I know many investors would wish they had come in much earlier, but then as we should be very careful not to join the bandwagon. You know what they say about investing 101, you buy low and sell high. So I don't think now is a good time to really be looking at equities. But of course, that is a broad market, the broad market comment. You can also still look deep within sectors and still find value. So if I'm an equity investor, I'll be looking towards 2024 and looking at which sectors are going to really, really drive the economy. What is the macro picture saying? What is the government focusing on? You could have opportunities in and there. in and around that. But just to, you can't just jump into the market and say, hey, I'm just going to buy equities because you've seen a 39% return this year.
Let's just bring it back very closely, very quickly. What's your outlook for the market next week?
So what we've seen this week for equities, I'll start with equities. What we've seen this week for equities is more of cherry picking. People picking up on names such as GTB, that had seen some decline over the previous week. So I expect that this cherry picking would continue going into next year, into the next week. So on the back of that, I would expect the market to trade sideways as investors begin to continue to cherry pick specific value names. Looking at the fixed income market, it really presents kind of a mixed outlook for me. Mixed outlook in the sense that at the last NTB auction, we saw very, very strong demand, over ₦1 trillion in demand coming into the 1 year treasury bill in particular. And what the DMO did was to take some of that and left a lot of money on the table whilst maintaining the cutoff rate. What we expect to see after such actions is that a lot of those who missed out in the auction would come into the secondary market and continue to push yields down. So that is on one side. So my outlook for the fixed income is that I expect the buying sentiment to continue on the short end of the curve. Okay. Whereas on the long end of the curve, investors will remain picky and continue to cherry pick, high yields like they will. So what we should see next week is a more steeper yield curve than we had seen in the current week. Yeah.
Okay. Thank you so much, Mr. Pambina Yinkere, Business Head, Asset Management, Nuremberg. Many thanks for your time this evening and for sharing your perspective on capital markets. Now, the Nigerian Exchange Limited has placed full suspension in trading of the shares of Consolidated Hallmark Insurance, that's GPLC, according to the NGX. The suspension was necessary to prevent trading in the shares of the company and to enable the company to reconcile its books with the Central Securities Clearing System for the delisting of Consolidated Hallmark Insurance PLC and the listing of Consolidated Hallmark Holdings PLC. It further notes that the suspension is required to determine the shareholders who would qualify for the consideration. And that's it on Capital Market. So join us next time for another edition. That's next week Saturday. We'll see you with our team. Thank you so much. Bye-bye.